adding tax to your DCF investment appraisal model is quite straightforward. We're going to look now at what happens. First of all, you'll notice that when we put the data in originally, in the tax rate input, we had 0. So I'm going to change that to 30. The nice thing about doing this is, because this is a self-correcting exercise, once we set the data to something apart from 0, the Excel model is expecting to see the tax amounts being entered in there, so we can immediately see what we have to put in. The basic income tax is quite simple because it's simply a percentage of our after interest operating income, and so that's the line above here. All we have to do here is put in minus the before tax cash flow, multiply that by the tax rate. I'm going to use absolute here so I can fill across. That gives me a nice tax number, and I'm going to fill that right across. That's nice and easy. You notice I'm not really paying too much attention to what's happening in year 6, and that's because the only reason I'm calculating year 6 is to work out the net operating income, and so leaving those numbers in here isn't important, especially since down below I've used that if statement that we introduced in an earlier video to zero out the final cash flows. So I'm simply not bothering. If you want to put if statements in there to remove those cash flows as well, you're most welcome. I'm simply not going to bother. Okay, we still have one more row of tax cash flows. This is for depreciation. Now, depreciation is a curious creature because it's not actually directly a cash flow, but it becomes a cash flow in the negative. Works like this. I might spend, let's say, $9,000 on replacing the carpets or the kitchen or something that's expected to last for 10 years. I get to claim a depreciation which is 1/10 of that amount each year on my tax. Now, I spend the money. The cash flow is a capital expenditure of $10,000. The tax deduction doesn't relate to a tax deduction on a cash flow for a particular year, but rather a fraction of the original purchase price that might have been paid for several years earlier. So the curious thing about this cash flow is that it always runs at the opposite direction to the expense. In other words, it looks like a cash inflow because that's exactly what it is. By claiming my depreciation tax deduction, I actually get the equivalent of cash coming into my pocket because I don't have to pay so much cash. So not having to pay so much cash is the same as receiving cash. Let's see how that works. I'm going to be assuming here something about the capital expenditure, which is not always the case, but for the simplicity of this model, it's what I'm assuming rather than splitting the capital expenditure up into a number of different rows. Some are going to be depreciated, some aren't, and that sort of thing. So rather than doing that split, which you can do quite easily, I'm simply going to assume that what I spend on capital expenditure is all going to be for depreciable inclusions. And in a separate video, I'm going to talk about how depreciation works. Okay, so here, to work out the deduction, I look at the amount that I've originally spent, which in this case is $9,000. I'm going to divide that by the economic life. That tells me how much I get to expense, to claim as a tax deduction each year. Now I'm going to multiply that by the tax rate, and that's in this case 30%. I'm going to add a couple of absolutes here because all of these are absolute. There are a couple of different ways of setting up these equations, by the way. I can do it like this and simply fill across, and that's what I'm going to do. And you'll notice that year by year I'm claiming a tax deduction of $900, and the tax benefit from that is $270 by the time I get tax at 30%. And so the cash is actually $270, which comes into my pocket. You'll notice the number is positive. Now, I've already written the equations down here in row 36 to already grab the tax related cash flows, and so I don't have to do anything more there. Those equations are now giving me the correct answer, and so my NPV is updating. Now there's one other little complication that I need to compute, and that is the capital gains tax. Let's go through how we do the capital gains tax. Capital gains tax, I'm going to start by bringing in the estimated sale price. Then I'm going to take away from that the estimated sales fees. We've calculated these before. Now we're going to look at the gross purchase price. Well, the gross purchase price, how many dollars has it actually cost me to acquire the property? That's going to be $270 plus the purchase fees. And that, from those I can work out the taxable capital gain, which is the difference between the $313 reduced by the sales fees and further reduced by the gross cost to acquire, and so I have $29,679 worth of taxable capital gain. And one more wrinkle here, a little unexpected thing, is that the lovely thing about earning or paying tax on capital gain is that you only pay it at half the tax rate. So here I take the $29,000, I multiply it by the tax rate, and then I divide by 2. Why do I divide by 2? There's no real theoretical answer to that, except that historically that's what the ATO or the Australian government decided to do, and you can give some thought as to what kind of pressures might have caused that to have happened historically. Now all we have to do is take our capital gains tax estimate, place it in our calculation for the sales cash flow, and that then brings our net sale cash flow down a tad. And because our calculations are all humming along happily, that's automatically brought it down, and so my net present value here, and for that matter all of my other estimates of investment performance, have all been adjusted accordingly. Nice thing about this, like so many things, I can change this to, let's say, 40%. The whole thing just adjusts. It's as easy as that. You'll notice that in this model we're not bothering about GST, and also we're assuming that other rates and taxes such as local government rates, land tax and whatever else is dealt with as expenses, so they're not being dealt with as tax. So when we're talking about tax here, we're talking specifically about income tax, and that's about it for our model.